Our next guest is optimistic, but says he still sees, quote, a wall of worry. Joining us now is Fritz Meyer, senior market strategist at Invesco, which has $430 billion in assets under management. Mr. Meyer, welcome to Bloomberg News. Good to have you back.
Hi, Mark. Thank you.
Sir, wall of worry. Please explain what you mean by this.
Wall of worry is that term that Wall Street tends to use when the list of concerns that are really bothering investors comes to the forefront. And I guess I would say that the wall of worry today is about as big as it gets, at least, and that's strictly a subjective perception. But I think the importance of this is coming off of a 60% bear market that's so fresh in investors' minds, and the wall of worry being what it is today. I guess it's not surprising that we have a 15% correction in this stock market. That's what I mean by wall of worry. But as you pointed out, I am optimistic. I think the equity portion of diversified portfolios should do well between now and the end of the year.
Well, then why have indexes been dropping at the end of the day? We saw that yesterday. What's going on?
Well, what you point to, I think, is again symptomatic of this wall of worry. In other words, we have these nagging doubts in investors' minds. And specifically, when I talk about the wall of worry, I'm talking about euro contagion, double dip, new normal, higher taxes here in the United States, the flash crash that you were just talking about, and the list goes on, the oil spill and so forth. So these nagging concerns that investors are just having a tough time getting over, and I think the cure here, unfortunately, is just time. And I guess the other thing I'd add that's so important to your viewers is that this correction highlights the importance of being broadly diversified and managing risk in an environment like this. But as I say, with respect to the equity portion of that diversified portfolio, I would be fully invested. I see higher stock prices by the end of this year.
When you say higher, how much higher?
Well, put it this way, the reason that I'm positive and optimistic is that the economic data in this country suggests, no, new normal and double dip are not in the cards. 3% GDP growth, I think, is what we can expect. Now, if that's true, we're going to see $80 in earnings on the S&P 500. Flash forward 6 months to the end of this year and apply a 15 PE multiple to, let's assume, an $80 per share number on the S&P, and you'd be at 1,200 on the S&P 500. Obviously, no guarantee of that happening, but it seems like a very logical conclusion, the path of least resistance for stocks.
You have been watching closely what's been going on over in Europe and these comments about a contagion. Does that give you cause for concern? You say that the economic data don't support a double dip, but that's our economic data. Is there a possibility that what's going on in Europe could spread over here and just upset the apple cart?
Well, you may have noticed in my ticking off the list of concerns, the wall of worry, euro contagion was right at the top of that list. So, yes, there is a risk. But I think, and in talking to the most expert people on this subject, the IMF, the OECD, these experts don't believe that we will have euro contagion. In other words, if we get a sovereign debt default in Greece, that may happen, but if it happens, it's out there somewhere. And even if it happens, it's not going to create a financial panic or crisis with the banking system in Europe. That's the key step. And so, no, I don't think you get euro contagion, particularly spreading to U.S. economic growth in any significant fashion.
Let's talk China for a minute. We're seeing now the biggest rise in Chinese exports in 6 years. Does that give you confidence that the world's fastest growing economy is going to continue to fuel a global economic recovery?
I think it's crucial, and I think the market has good reason to rally on this news. Remember, China is now the biggest single contributor to global economic growth. China's economy still is substantially smaller than the United States, but in terms of its contribution to global growth, it's huge. And so this is very important. It's symptomatic that outside of the United States and Europe, global economic growth actually is booming, and that will tend to support economic momentum here in the United States as well as Europe.
Will that also tend to support at least those on Capitol Hill who are saying perhaps that maybe now is not the time for Washington and Beijing to have a discussion about the revaluation of China's currency?
I think possibly, those political wranglings, I think, are ongoing, and frankly, I'm not too sure whether Washington can be effective in this discussion of revaluing the yuan, and I think the Chinese are going to do what they're going to do. We will see a higher yuan over time.
All right, Fritz Meyer, senior market strategist at Invesco, joining us live from Denver. Always good to have you on, sir. Thank you so much.
You're very welcome.